So should we all be preparing for more inflation, higher grocery prices, higher rent prices? What are we all to expect next? The central banks clearly understand that we've hit the debt limit on the economy. Check out this chart. When we look at this chart, we started this entire business back in 2008. Look at the level of debt in 2008, and then look where we are today, and then look where the projections take us in the next few years. It's absolutely ridiculous. And the reason that we're looking at this is because we want to live life on our own terms. And to live life on our own terms, we need to understand how the money game is played in today's world. Otherwise, it's like running on a treadmill and you're just never getting ahead. And that's why we look at this data. So let's take a look at this next chart. On this next chart, we're looking at the deficits. The deficits in the US are absolutely huge, and they've become so big that they are now breaking out the net interest outlays, or the net interest payments that they have, as a separate component when they're projecting the deficit. That's how big the debt has got in the US. And even though we're sitting here in Canada, the reason that we need to look at the US for instructions is because the US basically makes the rules for the rest of us. Canada, the Canadian economy, and the Canadian dollar is ultimately just a derivative of what's happening in the US. So whatever happens in the US affects us directly here in Canada, especially they're the biggest economy. We're a tiny economy relative to them. So it's just in our best interest to look at what's happening in the US. Now take a look at this next chart right here. When we look at federal government interest payments in the country, you can see back in 1970, if you look at all the way back in 1970, they looked kind of normal, or it looked like they were going up, but at a normal pace. And now look at the last few years from 2020 to current day. Interest payments are going through the roof. Now take a look at this next chart. On this next chart, I think this one was put out by Bank of America. If you look at the federal interest payments on the debt in the US, it's currently around 1 trillion or 1.1 trillion annualized. If interest rates don't change in the US, interest payments later this year, so a few months from now, are on pace to hit $1.6 trillion. Now, just for context, interest payments when we started our business back in 2008 looked like they were roughly $350 billion or so. Now we're talking about adding on 500 billion in a few months. This doesn't look sustainable. And if interest rates are cut, on this chart, I think they have a projection that if interest rates are cut a full 1.5 percentage points or 150 basis points, the interest on the debt still goes up to $1.2 trillion. So this is absolutely astronomical. And the reason this is important to me, my family, and the community that I live in is that to pay for this, we are destroying the purchasing power of the American dollar and the Canadian dollar. And we'll dive into that in a little bit here. I love this tweet here by Dylan LeClaire. He's basically saying the Western world is functionally insolvent. The political posturing is a complete joke. A structural debt jubilee via financial repression is the only option. Creditors and savers get pillaged in the process. So this concept of financial repression has been thrown around for a long time, and we've talked about it for a long time too. And it basically, a lot of this boils down to an International Monetary Fund working paper back in 2015. And if we dive into this particular paper, you can see in the abstract, the very first sentence of this is rather telling. It says, high public debt often produces the drama of default and restructuring, which is first off ridiculous that they're saying that public debt produces drama, like it's not an important thing. But the next sentence is telling, but debt is also reduced through financial repression. A tax on bondholders and savers via negative or below market real interest rates. And this is what we've had through the 2010s. We had negative real interest rates, and we got away from that in the last few years, and it's caused some problems in the economy that we're all seeing right now. And it looks like to me, if they're gonna play the financial repression playbook, we're gonna see that yet again. Check out this next sentence in the abstract. Financial repression is most successful in liquidating debt when accompanied by high inflation. So the International Monetary Fund is basically saying, hey, we can fix this whole debt thing if we play this playbook and just have high inflation, and I'll show you why this works to their advantage. Let's go to this next chart here for a second. We're gonna come back to that point. Check out the federal surplus or deficit in the US. The US deficit right now is at an astronomical level. You can see it right here on this chart. And if you go back to the 1970s, the 1980s, the 1990s, even around 2000, it never really got to the point it is right now. And in the US, the economy has been rather strong. So now we have a really large deficit. What happens if there's another recession or another crisis? What kind of money printing or deficit does the US run then? And what happens in Canada if the US starts printing a lot of money? We always seem to do a better job than Americans at printing more money. We will always run deficits in this country. We always want the Canadian dollar, and I'm not saying this is right, by the way, but we always want the Canadian dollar to be cheaper to really promote our exports and help our export-based economy. So if they're going to debase their currency to fund deficits like this, what are we going to do in this country? Take a look at this chart. This is consumer price index going back to the 1940s and 50s, and then through the 70s, and then current day. And you can see in the late 40s and into the 50s, there was a spike in inflation, and then it came down, and then it spiked again. And then you can see in the 1970s, inflation spiked, things kind of got under control somewhat, then it spiked again. And then you can see current day, the peak was June 2022 on this chart. We had an inflation spike, it's come down, and it looks to me if history is going to repeat when these spikes happen, we're due for another spike in inflation rather soon. And if you go back to that International Monetary Fund playbook, they were basically calling for high inflation. So financial repression is basically calling for high inflation. We had one spike, it came down, and now we have a historical precedent for another spike in inflation. So should we all be preparing for more inflation, higher grocery prices, higher rent prices? What are we all to expect next? Let's go to this next chart over here. This is something I put together that basically outlines an advanced economic example of what's happening. And I just want to begin this. It's a rather simple little chart that I put together here, but to me it summarizes a lot of things really clearly. And the ultimate point is the central bank's main job right now is to debase our money. Like that's their job. They are here to debase our money to fund all the debt and deficit spending that they're doing. And if you look at this advanced economic example that I put together, and I'm saying this is a little bit of a joke because it's really basic, but you can see GDP here is really small and the debt is really big. And the whole goal of what the central banks are trying to do is to get us to this, where the GDP is really big and the debt, although it might not have changed, it might not have gone down, because they juiced up the GDP, the debt relative to the new gross domestic product looks smaller. The method in which they would juice up the GDP like this is that if you don't get actual gains in the economy, you just print money and stuff it into the economy. You count all those dollars, the GDP looks larger, so then you can look around and say, oh my gosh, everything's in order, the GDP is bigger, our debt doesn't look as bad relative to the GDP. But when you print more dollars and stuff them into the economy so you can count a higher number, what it does to the rest of us here is it debases our currency, it debases our savings, it debases our purchasing power. So we have less purchasing power, everything costs more, and it breeds frustration in the community. No one really understands why they're not getting ahead, why their savings aren't getting ahead, even why some of their investments aren't getting ahead, which we'll dive into here. If you look at this chart of the S&P 500, this chart looks like it just goes up, and if you had invested in the S&P 500, although there's some times where it came down a little bit, over longer periods of time, it goes up and it just kind of looks like this beautiful thing. If you look at the United States Case-Shiller Home Price Index, same kind of thing. It goes up, it kind of hits a peak in 2006, 2007, hits the great financial crisis, comes down for a few years, but then it kind of goes back up and everything looks kind of good and there's no problems here. But what happens when you look at this with a different lens is it's not telling the whole story. And to set that up, I want to talk about the Federal Reserve's total assets. So the Federal Reserve, when capitalism, in my opinion, broke completely in 2008, the Federal Reserve started buying a lot of assets from the economy to help support the economy. So some banks had some bad assets on their books in the great financial crisis, and they said, hey, listen, you don't have to keep those assets on your books anymore. We will print some new money and buy those off of you so you look healthy and the system survives. That's not capitalism. Although people think we have capitalism today, when you save things like that in the name of the greater good, you no longer have capitalism. We need to let these bad institutions fail. But we didn't in 2008. And the Federal Reserve grew their assets to do that. They bought assets from the market to save the system. And a lot of people thought that was a really great idea. I think it was an absolutely horrible idea. But what that did is cause a whole bunch of unintended consequences. If you see M2, the M2 money supply in the US, from about 2008, it started ramping up a little bit more aggressively, or the trend line of the M2 money supply growth started going up a bit more aggressively than it had in the previous decades. And then if we go back to Canada, you can see in Canada, the M2 money supply also started increasing at a rather increased pace since 2008 as well. So whatever happened in the States, remember, it happens right here in Canada too. We're just looking at the States as the source of the problem. So now if we go back to the S&P 500 index and we look at it from the year 2008 or so, you can see that it's gone up and everything kind of looks good. But if we divide the S&P 500 by the increase in money supply in the economy, you can see that the S&P 500 didn't go up 292% as it shows in this chart. It only went up 30% since 2008. Although the numbers on your bank statement, or your investment statement on your screen, if you had invested in the S&P 500 since 2008, look like they had gone up a lot. If you had taken that money out to go purchase things in the economy, your purchasing power only increased 30%. Because of the increase in money supply in the economy. And that's the thing that most of us are not taking into account when we're looking at our investments. And that's kind of like the stealth tax that is being placed on all of us. Your investments look like they're going up, but you can't understand why you're not able to buy a lot more, even though the numbers on the screen are a lot higher when you look at your investments. Now, if we look at the same thing, at the same chart, if we look at the Case-Shiller home price index in the US from 2007, 2008, you can see it came down a little bit and then it went up. And it looks like it went up 54% or so on this chart. If we divide that by the increase in M2 money supply in the economy, you can see it's actually down, or your purchasing power is not up. It's actually down 48%. Because there are so many more new dollars in the economy, when you cash out your investment, you have less purchasing power. Your dollars are buying less. This is the stealth tax that exists in the world that too few of us, in my opinion, are paying attention to. So if we really want to live life on our terms, we need to understand these concepts. So I want to go back into this chart of the Federal Reserve's total assets. And back in 2008, it looks like something really went wrong here. And you can see since then, it's been going all over the place. And this guy on Twitter has done a really great job of just kind of labeling it. Sven Henrich put this tweet out, and he labels the monetary base, which is highly dependent on the Federal Reserve's assets. There's the increase in the monetary base in the US, QE1, there's QE2, there's QE3. And then after that, it was kind of decided that, hey, we've done a little bit too much here. We're not going to do quantitative easing. We're going to do quantitative tightening. So they pull some out of the economy. And then there was the pandemic, which launched QE4. And then after that, we had another round of quantitative tightening. But if you look at the very end of the chart, and he's calling it out in his tweet here, the monetary base in the US starts creeping up again. But we haven't had an announcement of why this happened. Like, why is the monetary base creeping up? Why is this happening in the economy? Why is this continued debasement occurring? And there's all these reasons behind the scenes. And one of the things that we should all be paying attention to is there's other facilities that the governments have and the central banks have that when they print a lot of new money, sometimes they will go to the banks and say, hey, don't leak this out into the economy. You can put it in some of our facilities. In this example, I have a chart up called the reverse repo. And the reverse repo is a place where banks can park some of their reserves. They'll even earn interest on some of these reserves and then kind of leave this monetary base sitting there, or these monetary instruments sitting there until they're needed. And you can see in the last few months, they started pulling the money out of the reverse repo and dispersing it into the economy. That's why on Sven's chart, although there's no quantitative easing, the monetary base starts increasing again because some of the previous expansion of the monetary supply was kind of parked, almost like, for emergency use. Didn't leak it out into the economy. They put it into here. There's another thing called the Treasury General account, which is basically the US savings account for the entire country, where when they get tax revenues, they'll kind of leave them in there. And then if they need to spend like crazy, they can kind of leak those dollars out into the economy and try and kind of get some stimulus happening. And that's basically what's going on, is that there's other facilities to get some new money out into the system to get some flow into the economy. And so if we look at some of this stuff, and if we look at the Canadian money supply, the M2 money supply here in Canada, we can see that like since January 2000 to current day, the compound annual growth rate of the M2 money supply in this country has been just about 7%, 6.94, which means that if you are not growing your income or your savings or your net worth, however you look at yourself, if you're not growing at 7%, so if your income's not going up 7%, if your savings is not going up 7%, if your investments aren't going up 7%, every year, compounded year after year, your purchasing power in the economy is falling behind. Because as a percentage of the monetary supply, the M2 money supply, you're not keeping up with the increase. So M2 money supply is increasing at 7% a year. And if you don't increase your purchasing power at the same rate, you're losing purchasing power. And this is the sneaky tax that we've been talking about in this whole video. You have to keep up at 7% compounded a year. So if somebody's making a quote unquote good investment and they're really proud of it and they're like, oh my gosh, I'm making an investment in the stock market or whatever it is, and it's going up 7% a year, and they feel really proud of it, well, you are just keeping up with debasement. You're not even getting ahead. And then if you take into account taxes or management fees of the investment, you subtract it off whatever your 7% gain was, you're actually falling behind. This is a primary reason why people feel frustrated right now. They can't keep up with the increase of money supply. Let's say you were lucky enough to be earning $60,000 a year. And we know now that the M2 money supply in Canada is increasing at 7% a year compounded. Well, if we take $60,000 and we grow that 7% a year, after 10 years, how much money do you have to be earning just to have the same purchasing power that you had at the beginning of that 10-year period? So if everything is growing at 7% a year and everything's getting debased at 7% a year, your $60,000 salary after 10 years has to be $118,000. And if it's not $118,000 after 10 years, you're falling behind. And if we go another 10 years, from $118,000, we extrapolate that forward another 10 years. Do you know how much you have to be making after 20 years? So you started at $60,000. We know debasement is going at 7% compounded a year. So you're trying to keep up at that 7% level. After 20 years, you have to be earning $232,000 a year to have the same purchasing power that you had 20 years previously at $60,000. And that's why things are so deceiving and people can't understand why they're not getting ahead, because most people are not growing their income from $60,000 to 20 years later to $232,000. So let's keep going. Let's look at a few other things here. If we look at the total assets that the Federal Reserve has been buying since 2008, we can see that they grew their asset base at about 14% compounded annually. And remember, the Federal Reserve's asset base really is the base for growing what is referred to as the monetary base. So the monetary base is kind of like a step under M2 or the M2 money supply. And if we look at the monetary base in the US, it's been growing at 13% compounded every year since 2008. And this now gets really interesting to me because maybe to protect our purchasing power, we shouldn't be trying to hit the hurdle rate of 7% a year to grow our income, our savings, our investments. Maybe to really protect ourselves, we have to be growing our income and our savings at 13%. And so what we've done here is I've taken the $60,000 salary, and now I'm not increasing at 7%. I'm going to increase at 15%, which covers the 13% that we just talked about. And I threw on a couple little extra percentage points, rounding up to 15%. So now what happens if I just want to keep up with the debasement, not at a 7% rate, but at a 15% rate. Because remember, I showed you the monetary base is growing at 13%, and we're not going to get into the details of that in this video, but the monetary base acts as collateral for lending and loans, which drive prices in real estate and everything else in the economy. So really, the hurdle rate maybe shouldn't be 17%. I can probably make a good argument here that it should be 13% at a minimum. And I've rounded up a couple extra points. So I'm using 15% in this example. If we take the $60,000 salary and we try to keep up with a 15% debasement rate, so we have the same purchasing power every year, and we try to grow that $60,000 salary 15% a year compounded over 10 years. Do you know what that $60,000 salary has to be after 10 years? It has to be $242,000 a year. Think about that. Your $60,000 salary after 10 years has to be $242,000 a year to keep up with this type of debasement. Then I did just for fun, and I don't know if this is like a horrible example or not, but I took it another 10 years. So if we take that income of $60,000 and we don't go 10 years, we go 20 years, do you know what the $60,000 income has to be after 20 years if we try to increase it 15% compounded annually? It has to be $981,000. So after 20 years, the $60,000 salary, if debasement is occurring at 15% a year, I'm just using these by way of example. You can look at this data and decide what the right number is for you. But at 15%, the $60,000 salary after 20 years has to be $981,000 a year, or you are falling behind. How ridiculous is that? And that's the game that we're all in. That's the game that we're in. And very few people seem to discuss this thing. And just by way of example, what happens if we take the $60,000 salary and instead of trying to increase it, what about if we say, okay, let's just keep it the same. The person that cannot grow that income, it stays the same. What happens if we just reduce it by 15% a year over 10 years? After 10 years, what does that purchasing power of the $60,000 feel like? And if we do that in this example, you can see on this chart here, after 10 years, that $60,000 income feels like it has a purchasing power of $14,000. Isn't that crazy? Because of the debasement and the increase in money supply, which makes the value of the dollars less, which is reflected in higher prices in everything around us, that $60,000 salary feels like it has a purchasing power of $14,000 after only 10 years. Imagine somebody retiring today on a fixed income of $60,000. 10 years from now, if we can agree that this debasement example, and I know it's just an example that I'm using a 15%, but why not prepare for the worst, right? Because if it's better, then great. But at 15%, that $60,000 salary feels like it has a purchasing power of $14,000. How ridiculous is that? And that's why when some people will talk to us and say, hey, it's really great right now at the bank, you know, I can get 5% on GICs. I mean, yeah, that's amazing. 5% is a lot better than we could get a few years ago. But is that gonna protect you from the debasement that's occurring right now? Is that gonna protect any of us from the next wave of inflation that looks like it might be coming our way? Is that 5% going to protect any of us from the International Monetary Fund's documented financial repression playbook that looks like it's being played out in real time here? So everyone's arguing about the price of housing, the price of rent, the price of groceries, and how everyone's blaming different people. Housing is blamed on investors. Grocery prices are blamed on, different grocery retailers. Is that really the problem, or are all these things second order effects of a monetary system that's completely broken? And because it's difficult to see, it's rarely discussed. And in our communities, with our neighbors, with our friends, with our families, at work, everyone's talking about all this stuff, but the theft is so secretive, it's so sneaky that it's happening every day and none of us see it. And it's why for us that we see two things that we've been focusing on over the last few years. I don't think it's any great surprise if you've been following us for any time that the reason we like leveraged income properties is because if you put 20% down on a property and 7% is the price that real estate has been going up in the greater Toronto area since the year 2000, if you put down 20% and the asset goes up 7%, That's a 35% return on our investment. That's the kind of return we need to outpace this debasement. It's also why we've liked Bitcoin. And Bitcoin, if you look at the compound annual growth rate of Bitcoin over any 4-year cycle, because Bitcoin can be very volatile, like we all know. If you've watched it at all, you know it's volatile. But if you look at the compound annual growth rate and smooth it out over any 4-year window, you can see on this chart that we're sharing here, the 4-year compound annual growth rates of Bitcoin are rather interesting. It'll hit things like 52% or 146% or 72 or 170. From March 2024, if you go back 4 years to March 2020, you can look that the compound annual growth rate of Bitcoin is 71%. That's astronomical. But everybody focuses on the volatility. And everyone will look at charts like this. Here's a chart of Bitcoin over the last 4 years against a whole bunch of other asset classes like the NASDAQ and the S&P 500 all on this chart. The REITs are on this chart. And you can see they're all at the bottom. And Bitcoin does look really volatile. It goes up, it comes down, it goes up, it comes down. So it kind of gets a bad name, in my opinion, for that reason in the financial community. But if we just smooth it out and look at the compound annual growth rates over 4-year windows, it's at a great rate that can outpace a lot of the debasement that is going on in the world right now. And that's why we're so focused on it. It's a beautiful new piece of property that never seemed to exist in the digital space, that is pure scarcity, that has these types of returns measured in fiat dollars. So these are the kinds of things that we believe you need to explore over the next few years, or you're going to get caught in this window of debasement, and 5 years from now, 10 years from now, you're going to wonder what happened. Why is my purchasing power as a person in this economy gone down so much? So that's what we wanted to cover in this. Hopefully that didn't get too serious. I did generalize on a lot of concepts and round it up in some of my numbers there to make a point. Hopefully you found this useful. And the reason, again, that we're sharing all this stuff is we want to live life on our own terms. Like, that's the whole goal for myself. And if you're watching this, it's likely the goal for yourself. You want to live life on your terms, do what you want to do. And to do that in today's economy, we need to understand these concepts. So hopefully you enjoyed that, and we'll talk to you soon.